Hi everyone, welcome to the first episode on retirement planning from FinFit Mantras. In today's video, we will break down 5 powerful shifts that define retirement for the 21st century workforce. To understand where we are going, we need to understand where we came from. Hence, we start the discussion by talking about the socio-economic factors which are distinctive of our generation vis-a-vis our parents' generation. We are joined by Mr. Dwaipayan Bose, who is the co-founder and director at Advisorkhoj. So, over to you.
So thank you for inviting me to this very interesting session. So retirement planning is a very important topic, and children usually follow the footsteps of parents. But uh, it is important to understand that we will face very different retirement challenges vis-a-vis what our parents faced. So let us first understand what are the main differences, the challenges and opportunities between the two generations, that is our parents' generation and our generation. So, firstly, income levels have increased significantly over the past, say, 30 years or so. So, in the early 90s, India's per capita GDP was about $550 or something. And as of 2024, it's nearly 2,700. So, that's a huge increase in per capita GDP. But if you think about the actual income levels of the middle class or the upper middle class, and the increase in income level is much higher than the national average per capita income growth. And this is also visible in lifestyles. If you think about the lifestyles that our parents have and the lifestyle that we have, there is a huge difference in lifestyle, and that is attributable mainly to income level difference. So higher income means higher investable surplus, higher savings, higher investable surplus. So that is definitely an advantage for our generation in terms of how much we are able to save for our retirement. However, a disadvantage is in terms of shifting social preferences. And one of the shifting social trends is people getting married at an older age. So in our parents' generation, people used to get married at an early age. They used to have kids early, and kids would complete their education and start working or not be reliant on parents financially, not be dependent on parents at a younger age of the parent. Now people are getting married later, so kids will be born later, and they would remain financially dependent on us for till we are much closer to retirement or maybe even after retirement. When somebody is dependent on us, it means a financial obligation on the parent. And so in the previous generation, people were able to get free of this financial obligation at a younger age compared to our generation. However, a major advantage of our generation is the evolution of financial markets. So if you think of our parents' generation, who work, who spend most of their working lives in pre-liberalized India. That is a period where they were in financial planning. We have two phases of wealth creation. One is the accumulation phase, and one is the distribution phase. So the accumulation phase is the pre-retirement phase, and the distribution phase is the post-retirement phase. So in the accumulation phase, our parent generation had limited investment options. And mostly people prefer traditional fixed income investments, bank fixed deposits, post office small savings schemes, traditional life insurance policies, etc. Some people would invest in stocks and bonds also. However, if you think about our generation, and we have spent our entire working lives in liberalized India, where financial markets have evolved tremendously, and we have far more investment options compared to the previous generation. So we have financial products like mutual funds, wide variety of mutual funds. We have exchange traded funds. Apart from and then we have alternative investments like portfolio management services or alternative investment funds, and then of course we also have access to international equities or even international bonds, either through mutual funds or through different platforms which enable investors to invest in international securities. So that's a plus for our generation. However, advantage which our parent generation had was they could rely on extended family support in case they ran into some financial challenges or they had to meet certain expenses post retirement. If we think of our generation, we should not we should not to expect our children to support us during our retirement. One, because as mentioned before, our children will become financially independent much later in our lives. So compared to previous generation. Secondly, in India, we are facing a huge shift towards urbanization. So cost of living in large cities will increase significantly. It has increased significantly. If you look at cost of living in a city like Mumbai, say 30 years back, and compare it with the cost now, then there is a massive increase in expenses. And at the rate at which urbanization is happening, the cost of living in a large cities, especially metro cities, for our children will be even higher. So their economic ability or the financial ability to support parents would be that much lower. And so investors of our generation should strive to be financially independent by the time they retire. And what do I mean by independence? That they should try to accumulate enough assets that can generate cash flows for them when they do not have income from their profession, which is basically the retired life. And finally, the economic landscape has changed significantly. If you think about the post-retired life of our parents, so assuming they would have retired somewhere in the 90s or in the early 2000s, and the next 20 years or 30 years following that was a certain economic environment. And when we retire, or our generation retires in the next 10 to 15 years, I believe we will be facing a very different economic environment. So that is something that we can talk about.
Yeah. Okay. Okay. So now let's zoom out because your retirement is not just about you. It is about the world you are retiring into. So in the next slide, we will touch upon the changing economic and macro landscapes.
Okay, so the challenges which our parents faced and the challenges that we will face will be different. If you compare the lifestyle of our parents and our lifestyles, they are very different. And that is simply related to income levels, right? As income levels go up, lifestyles go up. However, and your income level is at the highest just before you retire, right? Because assuming your salary is going up throughout your career, so just before you retire, your salary is probably at the peak. And so your lifestyle is also at the peak. Now, once you retire, you no longer have a salary from your job, but your lifestyle remains the same. It's not easy to change lifestyle. Lifestyle is one of the stickiest things in the world. So even though you do not have income from your profession, your lifestyle still remains the same. And so we have to factor that in our retirement planning. So our parents had a fairly, if you look at the gradient of lifestyle change of our parents, it was a fairly, whereas the gradient of lifestyle change that we have is a fairly sharp gradient. So we have to be prepared to spend much more than what our parents spent after retirement. And also, if you think about inflation that is linked to lifestyle, we would think of a different inflation basket. It won't be your typical CPI inflation basket, which is 4 or 5% or 6%. So, expenses related to lifestyle related things like branded apparel or dining out, etc., traveling, etc. Those the inflation related to those expenses are much higher than normal food and grocery and other expenses. The second thing that the challenge that our generation will have to face is that India is aging. The global population is aging, but and India is no different. So when in an aging population, health risks are higher, and so when a population is younger, the risk premium for health insurance is spread over a younger population and the older population. The younger population being the low risk population, and the older population being the high risk population. In some ways, the younger population is compensating for the older population. And so their premium would have been lower if the younger population is higher. But as you grow older, as the country ages, the proportion of the older population grows. And so naturally risk premiums rise. What I'm trying to say is that health insurance premium when we retire will be significantly higher compared to previous generations. Add to that the medical inflation, which growing at a much higher rate than the normal CPI inflation rates. Add to that the quality of healthcare, which is also improving. So everything gets factored into your health insurance premiums and your overall healthcare expenses. So you should be prepared to spend much more on health insurance and your health compared to what your parents did in their retirement years. The third challenge that we will face is falling interest rate, and this is where I would say that we need a major shift in mindset compared to our parents' generation. So our parents' generation mostly relied on traditional fixed income investments like bank FDs, post office small savings schemes, etc. Now, if you look at FD rates or even say small savings interest rates 20 years back or 25 years back, they were near double digit, sometimes even more than double digit, actually. Now think of Think of a scenario where you're getting 7-8% interest rate, and and maybe you are not in the taxable income bracket after you retire. So that's a much more comfortable position to in. But when we retire, interest rates surely will come down. Now, why interest rates will come down? Because as a country develops and the GDP keeps growing, over a period of time, inflation comes down, and inflation is directly related to interest rates. Also, as GDP growth rate slows down, the the central bank, in our case the RBI, will have to deliberately keep interest low to spur economic growth. So, keeping all these factors in mind, and historical data has shown that interest rates have come down. I have some data from China and Japan. Yes, in the early 90s, China's interest rate was around 9 to 10%, early to mid 90s. And now China's interest rate is below, and I'm talking about deposit rate. Now China's deposit rates are less than 2%. Japan, in the mid 70s and the early 80s, Japan's interest rates were around 6 to 7% deposit rate. Now they are less than 0.5%. So as you can see, if we aspire to become a developed country in the
US,
next,
like in terms of the trends,
yes,
in terms of the falling interest rates.
yeah, even you can be even we can see that even in the US, the interest rates have come down significantly from the mid 70s to now. Deposit rates are close to 0% actually, or maybe 1%. So now, if we want to become, and it's the vision of the government to become a developed country, Viksit Bharat by 2047. So if we take a view of the next say 20 years, following the trajectory of other developed economies or fast growing economies, our interest rates are going to come down significantly. And finally, we live in if you compare the world in which our parents live and the world that we will retire into, our parents' retired lives have been spent largely, and I'm talking about the period between say the mid 2025 or so. Uh, it has been largely in a stable global macro environment. I'm not talking about India, but global macro environment. There have been shocks like the global financial crisis in 2008, and then the COVID crisis in 2009. But I think the world that uh, we will retire into will be a much more complicated world.
Yeah.
One, because our parents, the world that our parents lived in was a unipolar world. The shift will be, and as most experts agree, that we will probably have a multipolar world in the future, and that transition is never very simple. Plus, there are uh, other complexities like the huge disruption which technology is supposed to cause. Technologies like artificial intelligence, then the shift from fossil fuels to renewable energy sources like or say clean energy sources. That transition also, these are all good transitions, but those transitions won't be easy. So we will have to live in a much more dynamic economic environment. And finally, speaking of equity investors in the last 30 years had a great run. But as the economy grows, if you look at Nifty returns over the last uh, 10 or 20 years, Nifty has given somewhere between 10 or 11, somewhere around 12% returns, sometimes even more returns. But if we look at the period from, say, the next 20 years, can we expect 12% return? I don't know. The answer is it's unknown. Because market returns are usually linked to GDP growth. So can we sustain GDP growth at a very high level, say 8%, 9%, or 7% for the next 20 years? As an economy develops, the GDP growth rate naturally comes down. It is simple. It's a simple base effect. If the base is very high, you cannot continue to grow at a high rate. China has done that for a longer for the longest period of time, but now their GDP growth rate is slowing down. And eventually, once our GDP, we were, I think we were at the fourth largest country, and now we have slipped. I'm sure we will soon be back at fourth largest economy, and then the third largest economy by 2030. By the time we are the second largest economy, somewhere down the line, can our GDP continue to grow at that rate? Is the big question. And market returns reflect economic growth. So market return, so expecting Nifty to give the same, or the equity market to give the same return as what it did 20 years back, might be an unreasonable thing. So we need to tailor our expectations according to that. However, there is market always presents opportunities. If you look at Nasdaq, which is really in a developed market like the United States, the Nasdaq actually was one of the best performing equity market indices in the last 5 to 6 years, and it continues to do very well. So there will be pockets of opportunities. You need to identify those opportunities and invest smartly for a bright and a secured future. So that's I think that those would be the main challenges that we would face, our generation would face in our retirement, and we need to be prepared for it. Over to you.
Sure. Okay, so now let's talk numbers because the numbers are not going to sugarcoat the reality. So if we look at the fixed deposit interest rate, and as you know, the fixed deposit used to be the default saving option for the previous generation. So the FD return rates are on an average about 6%. Now, if we consider the tax and we assume a 30% tax bracket, it effectively means that the rate of return is about 4.2%. Now, if we were to contrast this to the CPI inflation, that is about 6%. And I'm only considering the CPI inflation here, which is the inflation numbers, as stated by the government. And it's not even considering the lifestyle and the metro city inflations, which is obviously rising very fast. Now, if we were to compare this to the Nifty 50, if we look at those returns, so that has delivered roughly 11 to 12% CAGR returns over the last 20 years. So it is hence clear that the default choice of our parents' generation, which used to be the FD, cannot solely fund our retirement. Retirement for today's generation is not just about survival and meeting expenses. It also needs the safe cushion to maintain the lifestyle, things like traveling and passion projects, etc. Hence, some allocation in equity is needed to beat inflation and to ensure our lifestyle needs. Whilst we will cover more on this topic in our subsequent videos, one key takeaway here would be is that like the FD, which was almost like the no-brainer sort of default investment mode of our parents' generation, say today, if you wanted to invest in the market and you are confused by the thousands of stocks and mutual funds and complex sectors and jargons, it's time to look at the modern day default, which is the index fund. Whilst of course, there are many index funds, which are out there. The most popular one is the Nifty 50, which is basically the top 50 stocks of the NSE in terms of market capitalization. Again, the index fund, and specifically the Nifty 50, is considered the barometer of the stock market in India. And the fund composition is driven by the index, and it is the same irrespective of the ANC or the mutual fund company that you choose. We would love to hear your thoughts on the discussion we had today. So please do comment and let us know on any point which particularly resonated with you. Thank you.